Good evening. In the early hours of this morning, search engines and social media feeds have been flooded with headlines claiming a 2 a.m. emergency update regarding the so-called $2,000 tariff revenue payment. With the 2026 filing season in full swing, many Americans are looking for clarity on whether this windfall is a financial reality or a sophisticated political rumor. President Donald Trump has indeed taken to platforms like Truth Social to champion the idea of a tariff dividend, promising at least $2,000 per person to low and middle-income citizens. He argues that the trillions, his words, collected from his administration's aggressive trade policies should go directly back to Main Street rather than just servicing the national debt. However, our analysis of official Treasury and IRS data paints a much more complex picture. As of early 2026, there is no federal law authorizing these payments. Treasury Secretary Scott Bessent has confirmed that such a rebate fundamentally requires congressional approval, something that has not yet materialized. While the administration points to soaring tariff revenues, which hit hundreds of billions by late 2025, budget experts from the Tax Foundation and the Committee for a Responsible Federal Budget warn that a $2,000 payout for approximately 150 million eligible adults would cost between $300 billion and $600 billion. This creates a significant funding gap. So, while the headlines shout emergency, the legislative reality is one of wait and see. The Internal Revenue Service has explicitly stated that no such payment is currently scheduled for February or March 2026. Furthermore, the Supreme Court is still weighing the legality of the very tariffs intended to fund this dividend. Without a favorable ruling and subsequent legislation, the exact paperwork for individuals simply does not exist yet. We must remain vigilant as these emergency labels are frequently used by scammers to harvest personal financial data. The legislative wall: why executive action isn't enough. Moving deeper into the mechanics of this proposal, we must address the fundamental constitutional barrier: the power of the purse. While President Trump has popularized the tariff dividend via social media, he cannot unilaterally authorize a multi-billion-dollar payout to the American public. Under Article 1 of the Constitution, only Congress has the authority to appropriate federal funds. Treasury Secretary Scott Bessent clarified this in a November 2025 interview, stating that even if the administration desires to distribute these checks, they need legislation for that. As of late February 2026, no such bill has successfully passed through the House or Senate. Legislators on Capitol Hill are currently divided. While some populist factions support the rebate as a way to offset higher consumer prices, fiscal conservatives are raising alarms about the national debt, which has now surpassed $38 trillion. These lawmakers argue that any surplus tariff revenue should be directed toward deficit reduction rather than new spending programs. Without a formal bill signed into law, the IRS has no legal authority to generate checks or process claims for a dividend. This is why official IRS portals show no mention of a $2,000 payment for the current filing season. The gap between a political vision and a legislative reality remains the most significant hurdle for any hopeful recipient. The $400 billion gap: analyzing the economic feasibility. Audio script: the feasibility of the $2,000 payment ultimately comes down to a simple math problem that currently doesn't add up. Budget analysts from the Tax Foundation and the Penn-Wharton budget model have meticulously compared projected tariff revenues against the proposed costs. To send $2,000 to approximately 150 million eligible American adults, those earning under $100,000 annually, the federal government would need between $300 billion and $600 billion. However, the revenue generated by the new 2025 tariffs, while record-breaking, reached only about $309 billion by late October. Even the most optimistic projections for 2026 place tariff income around $207.5 billion. This creates a massive funding gap of several hundred billion dollars. Furthermore, the administration has already pledged much of this revenue to other priorities. In previous statements, the Treasury has noted that tariff funds are intended to offset the costs of the One Big Beautiful Bill tax cuts and to reduce the soaring federal deficit. Economists warn that attempting to fund a universal dividend while also paying for tax cuts and debt reduction would require either much higher tariffs, which could trigger inflation, or further borrowing. This economic friction is why many experts label the $2,000 figure as aspirational, rather than a calculated fiscal plan ready for immediate implementation. The judicial roadblock, the Supreme Court and IEPA. Beyond the halls of Congress, a major legal battle in the U.S. Supreme Court is casting a long shadow over the future of tariff revenue. The case, Learning Resources, Incomes v. Trump, challenges the president's authority to impose broad tariffs under the International Emergency Economic Powers Act, or IEEPA. This 1977 law was originally designed for targeted sanctions, but the administration has used it to enact sweeping 10% and 25% duties on a wide range of goods. In oral arguments heard in late 2025, several justices expressed skepticism. Chief Justice John Roberts noted that because tariffs generate revenue from American consumers, they implicate the core taxing authority specifically reserved for Congress. Justice Sotomayor raised concerns that an emergency declaration could allow any president to bypass the legislative process indefinitely. If the Supreme Court rules the tariffs unlawful in early 2026, the entire financial foundation for the $2,000 dividend could collapse. In that scenario, the $90 billion already collected might actually have to be refunded back to the importers who paid them, not the general public. This legal uncertainty is a primary reason why no paperwork for consumers has been issued. The government cannot distribute money that the courts may soon order them to return to businesses. Proposed dividend versus duty drawback, clearing the confusion. The 2 a.m. updates often confuse a proposed political rebate with an active federal program. While the 2000 consumer check remains a possibility for mid to late 2026, there is a very real, legally established mechanism for getting tariff money back right now, but it isn't for everyone. It is called duty drawback. Established under 19 U.S.C. Paragraph 113.13, duty drawback is a statutory right for businesses, not a stimulus for individuals. It allows companies to recover up to 99% of the duties, taxes, and fees paid on imported goods that are later exported or destroyed. While social media posts might use the phrase tariff refund to lure people into clicking on scam links, legitimate tariff refunds are currently a B2B, business-to-business reality. For the average citizen, there is no application form, 1040D, or a tariff dividend portal on the IRS website. The exact paperwork people are searching for is actually the complex documentation required by U.S. Customs and Border Protection for commercial importers. Understanding this distinction is vital to avoiding frustration. If you are a consumer, you are waiting for a law to be passed. If you are a business owner, you are looking for specific import-export records to claim money that is already legally yours. Duty drawback, the only real tariff refund available now. For U.S. businesses struggling with the 18% average tariff rates, the highest since the 1930s, duty drawback is the most powerful tool for cash flow recovery. This federal program, managed by Customs and Border Protection, CBP, is not a new invention. It has existed since the first U.S. Tariff Act in 1789. Its logic is simple. The U.S. government should not profit from duties on goods that do not stay in the domestic economy. If your company pays tariffs on raw materials from Asia or finished goods from Europe, and then you export those items or products made from them to Canada, Mexico, or elsewhere, you are legally entitled to get 99% of that money back. The remaining 1% is kept by the government for administrative costs under the Trade Facilitation and Trade Enforcement Act of 2015. Unlike the proposed consumer dividends, duty drawback is a guaranteed right, provided you have the proper documentation. It covers not just the basic duty, but also merchandise processing fees and harbor maintenance fees. For many companies, this represents a recovery of hundreds of thousands or even millions of dollars that would otherwise be lost to the Treasury. The 3 pillars of drawback eligibility. To claim a real tariff refund today, your business must fall into one of 3 specific categories defined by the statute. First is unused merchandise drawback. This applies if you import goods and then export them in the same condition without ever using them in the U.S. An example would be an apparel distributor who imports 10,000 shirts and later ships half of them to a satellite warehouse in London. Second is manufacturing drawback. This is for companies that import raw materials or components like aluminum sheets or microchips and use them to fabricate finished products that are then exported. Even if the imported part is only a small fraction of the final product, the duties paid on that part are recoverable. Finally, there is rejected merchandise drawback. If you receive a shipment that is defective, non-conforming to your order, or sent without your consent, you can get a refund if you export it back or destroy it under CBP supervision. Whether you are a distributor, a manufacturer, or even a retailer returning unsold stock to an overseas supplier, these are the only paperwork paths that lead to a legitimate government payment in early 2026. The 5-year look back. Retroactive refunds. One of the most valuable aspects of the current tariff refund law is its look back provision. Many businesses assume that if they didn't file for a refund at the time of export, the money is gone. In reality, duty drawback is retroactive. You generally have a 5-year window from the date of import to match that import with a qualifying export. This means that as we sit in February 2026, your company could potentially recover duties paid as far back as early 2021. This look back is crucial because it allows for a historical audit of your trade data. By pairing 5 years of entry summaries with 5 years of bills of lading, companies often discover hundreds of thousands of dollars in hidden cash. However, there is a technical requirement called substitution. Under the Trade Facilitation and Trade Enforcement Act, you don't necessarily have to export the exact same physical unit you imported. As long as the imported and exported goods share the same 8-digit Harmonized Tariff Schedule (HTS) classification, they are considered commercially interchangeable for refund purposes. This flexibility makes the exact paperwork much easier to manage, but it still requires a high degree of precision in your record keeping to satisfy a CBP audit. The exact paperwork for businesses documentation guide. So what is the exact paperwork required to actually get this money? For a business, it is a multi-layered documentation trail. The foundation is CBP Form 7501, also known as the Entry Summary. This proves that you were the importer of record and that you actually paid the duties. You will also need the commercial invoices for both the import and the subsequent export to establish the value and description of the goods. Next comes the proof of export. This usually takes the form of a bill of lading or an airway bill, which provides a neutral third-party confirmation that the goods left the United States. If you are claiming manufacturing drawback, you must also maintain production records or a bill of materials to show how the imported component was used. Finally, inventory logs are essential to provide traceability. Unlike a simple tax credit, duty drawback is a matching program. If you cannot link the inbound duty payment to an outbound international shipment, the claim will be rejected. This is why many companies are now moving away from manual spreadsheets and using automated platforms to scan thousands of entries and exports to ensure every possible dollar is captured accurately. Timelines. How to get paid in 30 days. The most common question businesses ask is, how long does it take to get the check? Under the standard process, it can take 1 to 4 years for a claim to liquidate and for the refund to be issued. However, there is a fast-track option known as accelerated payment. By applying for this privilege and providing a specialized drawback bond, companies can receive their refunds in as little as 30 to 45 days after filing. This bond acts as a guarantee to the government that if the claim is later found to be invalid during an audit, the money will be returned. For companies with significant capital tied up in tariffs, the cost of the bond is a small price to pay for immediate liquidity. It is important to note that the clock only starts once the claim is filed through the ACE portal automated commercial environment. Paper filings are no longer accepted by CBP. Whether you use a licensed customs broker or an automated software solution, the goal is to move from unliquidated status to refund issued as quickly as possible. In a high interest rate environment like 2026, getting that 99% refund back into your operating budget in weeks rather than years can be the difference between growth and stagnation. Real 2026 relief, the $6,000 senior deduction. While the $2,000 tariff dividend is still a proposal, there is Avery, real and significant tax benefit for seniors that has been signed into law under the One Big Beautiful Bill Act. A new enhanced deduction for seniors is available for the 2025 and 2026 tax years. Taxpayers who are age 65 or older by the last day of the tax year can now claim an additional $6,000 deductions per person. For a married couple where both are eligible, This jumps to a $12,000 deduction. This is in addition to the standard deduction already provided under existing law. The best part? It is available even if you don't itemize your deductions. However, there are income limits to be aware of. The benefit begins to phase out for individuals with a modified adjusted gross income over $75,000 or $150,000 for joint filers. This legislation was specifically designed to provide immediate inflation relief to retirees who are most affected by rising costs. So, while you may be waiting for news on tariff checks, make sure you don't miss this guaranteed $6,000 deduction when filing your 1040 SR this year. It is a bird in the hand compared to the two in the bush of the tariff proposal. Social Security 2026, COLA and taxable maximums. For the 75 million Americans receiving Social Security or SSI, 2026 brings several automatic adjustments that are already in effect. The Social Security Administration announced a 2.8% cost of living adjustment, COLA, for this year. On average, this means retirement benefits will increase by about $56 per month starting in January. While this is slightly lower than the 3.1% average of the last decade, it reflects the cooling, but still present, inflationary trends. Another critical update involves the taxable maximum. For those still in the workforce, the maximum amount of earnings subject to the Social Security tax has increased to $184,500, up from $176,100 last year. If you are a beneficiary, you should have received a simplified one-page COLA notice in December 2025. If you haven't seen it, you can log into your My Social Security account at ssa.gov to view the exact dates and dollar amounts of your new benefit. This 2.8% boost is a promise kept to ensure benefits reflect today's economic realities. For those also receiving Medicare, remember that your new premium amounts will be deducted from these increased payments, so checking your net amount online is the best way to plan your 2026 budget. Filing assistance. Free resources for 2026. Navigating these new deductions and potential credits can be overwhelming, but you don't have to do it alone. The IRS and various nonprofits are offering expanded free tax preparation services this season. For those with low to moderate income or those over age 60, the VITA, Volunteer Income Tax Assistance, and TCE, Tax Counseling for the Elderly programs are fully operational. Additionally, the AARP Foundation Tax Aid has set up thousands of locations in libraries, malls, and community centers nationwide. These experts can help you ensure you are correctly claiming the Earned Income Tax Credit, EITC, which has a maximum income limit of $68,675 for the 2025 tax year. They are also trained to handle age-specific issues like required minimum distributions, RMDs, and Social Security taxation. If you are looking for the paperwork for any government payment, these sites are the only legitimate places to get help. Remember, the IRS will never charge you for information about your refund. Using these free resources not only saves you money, but also ensures that your return is filed accurately, reducing the risk of a 2 a.m. emergency audit later in the year. Scam Alert: How to Spot 2 a.m. Emergency Fakes. As we approach the peak of the filing season, we must issue a critical warning. Scammers are weaponizing the phrase $2,000 tariff payment to steal your identity. These 2 a.m. emergency updates often come in the form of unsolicited texts, emails, or social media ads that look remarkably official. They may claim you need to register now or verify your bank account to receive a tariff rebate. The IRS has been very clear. They do not initiate contact by email, text, or social media to request personal or financial information. Any legitimate communication about a new federal payment would begin with an official letter sent via the U.S. Postal Service. Furthermore, there is no non-filer tool for a tariff dividend because the dividend doesn't exist yet. If a website asks for your Social Security number or your bank routing number to claim your tariff check, it is a scam. Protect yourself by only using irs.gov and checking your online account to verify any true payment history. If you encounter a suspicious message, report it to the Treasury Inspector General for Tax Administration, TIGTA. Staying vigilant is your best defense against those trying to profit from the current trade headlines. The final verdict: Your 2026 financial strategy. To conclude our deep dive into the $2,000 tariff revenue payment, the headline is a proposal, but the reality is a process. As of today, February 2026, there is no check in the mail for individual consumers and no exact paperwork to file for one. The tariff dividend remains a political goal that requires both congressional approval and a favorable Supreme Court ruling. However, your financial strategy for 2026 should focus on the knowns. First, if you are a business that imports and exports, leverage the duty drawback program to recover up to 99% of your tariffs now. Second, if you are a senior, ensure you claim the new $6,000 enhanced deduction. Third, enjoy the 2.8% COLA increase in your Social Security checks. And finally, stay informed through official government channels like irs.gov and ssa.gov. Don't let 2 a.m. emergency headlines drive you to risky decisions or expose you to scammers. The trade landscape is changing rapidly, but the path to financial security is built on verified facts, not social media rumors. We will continue to monitor the Supreme Court and Congress for any shifts in the tariff policy. Until then, keep your records organized, your data secure, and your expectations grounded in reality.